Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 114 on May 16th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on MacroGenics Inc., the iShares investment grade corporate bond ETF, and the VanEck Vectors Junior Gold Miners ETF. And then we discuss three new trades on OPKO Health, Penn National Gaming, and Delta Airlines. It's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on the show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now this week, the equity markets pulled back a couple of percentage points. The Dow Jones Industrial Average lost 645 points, ending the week at 23,685 points. The S&P 500 index fell 66 points, closing at 2,863 points on Friday. So now it's time to dive into the topic of the week. And this week, we're going to discuss something that I think a lot of people can miss, especially when they're just starting out in trading, not even just option trading, but trading in general. And that's becoming an expert. There's a value in becoming an expert. And I'm not just talking about becoming an expert trader. I mean becoming an expert on a handful of companies or ETFs. So each week I come up with trade ideas from a variety of companies on this show. And the main reason is I try to limit how often I repeat the same company. Otherwise, you guys would get bored. You say, okay, well, which S&P 500 ETF, trade is he going to come up with this week? Which Bank of America option spread is he going to look at? That show would be boring. So I'm challenged with finding trades in a variety of companies across the vast spectrum of equity options that are traded here in the US. I don't advise that you do that, right? The challenge is that you end up becoming a jack of all trades and a master of none, or a jack of company information and a master of none. In my own trading, I tend to stick to a handful of ETFs that I like to trade in my own accounts, and I know how they trade. I have a good idea of what happens and how the market's going to respond if I put out a large or small amount of volume. They're just all of these smaller details, little packets of information that you'll get once you start focusing on trading a handful of companies rather than trading all of the companies in the S&P 500 index. So here are three main reasons to focus on becoming an expert. Number one, when you become an expert on a specific company or ETF, you have an edge, right? There's asymmetric information, meaning you're going to have information about the company that the market may not know or may not aggregate together the same way that you're going to use it for trading. So you will gain a better sense of how the management team will respond to news, and it's just going to make you a better trader. Number two, you'll get to know how the market will respond to different events. So I have a few names that I know so well that I can tell even how the algorithms in that market will respond to my actions. That's a huge advantage. Though I don't advise manipulating a market, sometimes you just know what the other traders are going to do when you put out your market order. And a handful of you know, I also trade cryptocurrency during the week. And it's funny because that is a largely algorithmically driven market. And I can tell when I place a trade, sometimes I will watch the algorithms move so quickly. And the reason I know it's an algorithm is because it's like two competing software pieces going back and forth, and the changes they're making are far faster than what a human would make. So it just gives you an edge. And then number 3, you can watch history repeat itself. What I mean by that is that you'll notice patterns in market behavior that tend to occur over and over again with specific companies or ETFs. It's almost like trading today with tomorrow's newspaper in hand, right? Like if every time a company releases a piece of news or releases earnings, you see the market pull back for about 2 hours and then spike to make a new high. You see that over and over and over again. Chances are you can expect it to happen the next time they release earnings. So when you focus on a handful of trades, you get good at, or you can become better at being able to predict or have a strong indication of where the stock's going to go after news is released. So that's it. I just wanted to make sure that everyone understood that even though I'm presenting new companies each week, that's not how I trade with the larger part of my portfolio. It's worth taking the time to become an expert. So with that being said, let's look at the trade review from last week's trades. We're going to start off with the covered call on MacroGenics Inc. Symbol M as in Mike, G as in Golf, N as in November, X as in X-ray. At the time, the stock was trading for $20.34 per share. I looked at buying the stock and selling that June 22.5 call at $2.55, hoping for a 23.16% return in 6 weeks. I believe I said 4 weeks last week. It was 6 weeks away then. So MacroGenics stock grew $5.46 this week, ending the week at $25.80 per share. The call we sold is now in the money by $3.30. Closing the trade would actually lead to a net loss because of how high the call option is currently priced and the bid-ask spread that the market maker put. However, holding this trade through expiration, assuming stock remains higher than $22.50 per share, will net you your maximum return of 23.16% over the next 5 weeks. Any questions? I mean, that's huge. No adjustments are needed. And one person emailed me this week and asked me, first off, mentioned that some of their largest returns have been on some of these run-ups that have happened with regards to these covered calls. Part of the reason these stocks will catch my attention is that the at-the-money call is at or higher than 10% of the strike value. So you can use that when you're looking at some of these things. I like them to be 10%, or I at least want to see a total of 10% when I take into consideration the difference between the strike of the at-the-money option and where the stock is. Take that difference plus the amount of money you're going to receive for selling that call. So if I can lock in at least 10% there, then that's a call up. That's a covered call that I would consider doing. And when you have 10%, when you're receiving 10% of the strike value by selling that option, that also ends up being your cushion. So you have a 10% cushion, additional cushion from where that stock is right now. So those are a couple of tips. I normally don't get that detailed on the cover call strategy, but for those of you who listen this week, consider it a freebie. That's how I find these covered call strategies, and that's really what's been the indication of some of these companies that have really blown up. I mean, this little stock had a 25% run up in 1 week. So it's pretty amazing. And even so, you could have gotten that with the stock, obviously, but having less financial exposure by having the stock and selling the call option, you're actually locking in 23%. So not bad. All right, let's dive on into move on into the credit spread. I looked at the iShares investment grade corporate bond ETF, symbol L as in Lima, Q as in Quebec, D as in Delta. At the time, the stock was trading for $126.66 per share, and I sold the June 127, 128 call spread at 35 cents, which can lead to a maximum loss of 65 cents. And this is a company I actually this is an ETF that I was not familiar with prior to last week. When it comes to bond ETFs, I've always looked at the TLT. I've looked at the Treasury ETFs. I hadn't looked at the corporate grade ETF. I've even looked at the high yield ETF, which trades fairly well, and all of these have options on them that trade very liquidly. So you can certainly look at that if you feel like you have an edge or know something about interest rates and bonds. But let's get into this. So LQD stock rose $1.89 per share this week, ending the week at $128.55. The out-of-the-money call spread we sold is now in the money. You can buy the spread back right now for 80 cents, which will lock in a loss of 45 cents per share. Per spread. So remember, this spread looks like it will close being worth $1 with stock where it is right now. So you can still lose an additional 20 cents per spread if you stay in the trade. So right off the bat, I would exit this trade and look to establish another trade that will offset that risk and give me another chance to profit on this name. Now, I like selling the iron condor, selling the June 130, 131 call spread and the June 128, 127 put spread for a total of 45 cents. This gives you a profit range of $127.45 all the way through $130.25 per share. So you end up with, just shy of a $3 profit range on this stock. Now, since this is just a trade to break even, because we lost 45 cents on the spread, and we're hoping to make that 45 cents back on this iron condor. So this is a break-even trade. I'm not really that excited about executing it. In fact, I'm more likely to just close out the first trade and walk away. This is also why I say trading is very personal, because some people will say, you know what, I'm going to put that additional trade on to go ahead and save money, to protect a loss. I don't want to lock in a loss. I'm going to go ahead and put this other trade on and hopefully make my money back. The problem with that idea is that even though you're collecting 45 cents on this trade, these are $1 wide spreads, so you could still lose an additional 55 cents. Whereas if you just held on to the original credit spread, you would only lose possibly another 20 cents. So this trade, the design of it itself, this is a separate trade. It doesn't reduce risk, it actually adds risk. And this trade fits perfectly for some risk appetites. I need to know there's a high likelihood, or at least a chance, of locking in a small profit. So let's say I could have sold this even for 55 cents and would turn this into a 10-cent profit right now rather than just breaking even. That would actually alter my view of this trade versus what it would be right now. So doing this trade at break even with the loss from last week isn't appealing to me. So I'm going to walk away. I hope you guys are, at least those of you who decided to participate, or those of you who are just listening to the show and listening to my rationale, I hope you're understanding the rationale behind how I weigh risk. Remember, to me, trading is not just this game of making money. It really is the game of managing risk. And if you can control risk, you can end up putting yourself in a position to profit. But if all you think is about, when I say the word P&L, if all you think about is profit and you don't take into consideration the size and magnitude emotionally of that loss, and sometimes the emotional side of a loss is far greater than the actual dollars themselves. If you don't take that into account, you probably won't be in the game of trading long. And then our final trade from last week is a debit spread. We looked at the Junior Gold Miners ETF, symbol G as in golf, D as in Delta, X as in X-ray, J as in Juliet. At the time, the stock was trading for $43.09 per share. We bought the June 42-43 call spread for 60 cents, hoping for a maximum gain of 40 cents or 66.67% return in 4 weeks. Well, the GDXJ ETF grew $2.83 this week, closing at $45.92 per share. The in-the-money call spread we purchased is now even more in the money. So the bid-ask spread on these trades is, again, rather large. And because of that, closing the trade at current price, the current posted prices, would lead to a 15-cent loss. I actually wouldn't advise ever really trading on the bid-ask spread. oftentimes you can put in a market order, a limit order that middles the market. So you put the pricing at the middle point of both options, not at the listed offer and bid. We know ultimately that this trade is going to be worth $1 because of the ability, or the trade, it's not even that it's going to be, it's worth $1 today because right now you can exercise that June 42 call and collect the ETF, and someone may go ahead and assign you on the 43 call, which means that this trade right off the bat can be worth $1 in stock value. Now, the option isn't going to be worth that for a little while longer because there's still time left, but I would simply look at holding this trade and wait on the markets to catch up to the value of this trade. If the ETF is priced here in 5 weeks, we're going to lock in 40 cents profit on the capital, right? So you spent 60 cents, capital of 60 cents, you'll lock in 40 cents on a profit because this is a $1 wide spread. So that's 66% return in 5 weeks. So if only all of my trades locked in 66% per month, I'd be and I'm a happy man already. I don't know if you guys have caught that. I'm an extreme optimist, but if my trades all made 66% or more, oh my gosh, that's what I dream about. Anyway, this week, let's look at this week's trade. So yesterday, Friday, May 15th, was options expiration for all May options. So you can expect to see on Monday the half strikes come in, the 50-cent strikes. So of the trades that I'm going to present here on the show today, many of them will have better pricing and better opportunities with some of the half prices, the half strikes rather, that'll be priced on Monday. So keep that in mind. So we're going to start off with the covered call. I'm looking at another company I'm not as familiar with. It's OPKO Health. I normally don't touch these kind of stock, and I'll explain later, but the stock right now ended the week at $2.62 per share. I'm looking at buying that stock and selling the June 3 call at 30 cents, hoping for a maximum return of 25.95, basically a 26% return in 5 weeks. And the symbol is OPKO. O as in Oscar, P as in Papa, K as in Kilo, O as in Oscar. Now you enter this trade by buying OPKO stock for $2.62 per share and selling the June 3 call at 30 cents. This trade makes the most money if stock prices finish above $3 per share, and the break-even price is $2.32 per share. The stock purchase in real terms would require $262, and you would collect $30 for selling the option. Now, the reason I normally don't get into stocks like this is because this is a penny stock. So some of you may not even have brokerage accounts that allow you to trade stocks that are worth or that are trading for under $5 per share. If it's under $5 per share, it's considered a penny stock. However, the metrics still work out for this trade to work. And what I love about it is that if we take a loss, right, the exposure on a covered call is not on the call itself. The exposure is on the stock that you own. This stock is priced like an option. I mean, $262 is your max, actually $232 is your maximum risk on this covered call. So I actually like this covered call. The stock is hard to borrow, so your brokerage would likely be happy with you buying some shares as well that they can allow other people to lend out on margin. But that being said, let's move on to the credit spread for the week. And I'm looking at another company I haven't touched in quite a while, and that's Penn National Gaming, symbol PENN. P as in Papa, E as in Echo, N as in November, N as in November. The stock ended the week at $19.35 per share, and I'm looking at just selling the June 19-18 put spread, collecting 35 cents on the spread, which gives us a maximum possible loss of 65 cents per spread. Now you enter this trade by selling the June 19 put at $2.35 and concurrently buying the June 18 put for $2. This is the credit spread because we are selling the spread, and this trade makes the most money if stock prices stay above $19 per share. The break-even price is $18.65 per share in the stock. And in real terms, you would receive $35 for every spread that you sell, and you will have $65 of risk. Our final trade on the week is a debit spread, and I'm looking at Delta Airlines. Symbol D as in Delta, A as in Alpha, L as in Lima. Stock ended the week at $19.19 per share, and I like to buy the June 21-20 put spread for 67 cents, which yields a maximum possible gain of 33 cents or 49.25% return in 5 weeks. Now you enter this trade by buying the June 21 put for $3.40 and concurrently selling the June 20 put at $2.73. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices stay below $20 per share. The break-even price is $20.33 per share in the stock, and in real terms, you will pay $67 to enter the spread, and you're hoping for a maximum gain of $33 per spread. So that's it for this week's show. Thank you guys so much for listening. Feel free to email me with any questions, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.